So we have learned how to prepare the financial statement, the income statement, and the statement of financial position. But you'll find that basically, don't just go straight recording or preparing the financial statement. You'll find some of our accounts, they need adjustments before we prepare the financial statement. Now today, I want us to look at those adjustments. And number one, let's start with prepayments and accruals. So we start with prepayments. Prepayments, we have prepaid expenses. So it is normal for a business in the normal course of trading that some of the expenses the business will have paid in advance. That is, the expenses have been paid for, but they have not yet been incurred. An example is when you pay for insurance premiums. Insurance premium, maybe you pay for a whole year. Okay? You pay this insurance premium in 1st August. Okay? 1st August 2024. Then your year ends in 31st December 2024. So this insurance premium, it is to cater for insurance for 1 year. From 1st August to 31st July 2025. That is 1 year. So at the end of the period, as at 31st December 2024, some of the insurance have not been consumed, yet you have paid for it. So you have to do the apportionment. Okay? So if this insurance was to be paid 12,000, you count the number of months from 1st August to 31st December. How many months are those? There is August, September, October, November, and December. So for the year 2024, it is 5 months, which is 5,000, isn't it?
Yeah.
Then the other amount of 7,000, this is prepayment. Now, how do you account for this prepayment? This amount in the insurance account, you have paid, okay? So, bank, 12,000, okay? And the double entry related to the bank account.
Yeah.
Then, at the end of the year, you have to take how much to the income statement. This one. This is what pertains to 2024.
Yeah.
So, the income statement you have to take 5,000. Then, our balance carried down will be the prepaid.
Yeah.
The prepayment. You can write prepayment here. 7,000. So that your accounts now can be closed. Then, when you go to the income statement itself, this is an extract, not a full one. On the side of expenses, you write how much? 5,000. Okay? That will be the expense for the year. Okay?
Yeah.
Then, if you come to the statement of financial position, on the side of current assets, that is where this balance is going to. So you have prepaid,
So,
insurance, That is how it treats prepaid expenses. Now, let's look at income in advance. Sometimes it is possible that some customers pay us before they get the goods or before they incur a service. So you have to account for that money. So a good example is maybe in a trading business, where they're paying and selling, and then you have there's some building they're subletting out, okay? So they're renting out, so they get rental income, okay? Yeah. How do you pay the rent? You pay in advance, okay? Somebody has paid a rent for January. We are in December 2024, okay? Somebody has paid for rent up to January 2024, 25, and it is 5,000, and you have received that money. Or it can also be in a case that we have received that money like in August for a whole year. But when it comes to the end of the year, there is some money that we have, but it's for the next period, not for the current period. So this money, they pay rent income, they pay rent on monthly basis 5,000. So they have paid, this money was paid in November, okay? Somebody paid in November, akakupea 10,000. That is rent for 2 months. That is December, now January, okay? So that's such that when it comes to the end of the period here, you have this amount that you have received in advance. Now, how do you account for it? In the rent of income account, you have that amount. How much did you receive? Bank. You have received 10,000. Okay? And then of this 10, there is in advance income. Advance payment, which is 5,000. So our income statement, we are going to take how much? 5,000. So any amount in the income statement, we take that particular amount that is pertains to that financial period. If you come to the income statement extract, after the gross profit, you add other incomes, or you add rental income, then 5,000, not 10,000. Okay? Because part of this 10,000 is for the next period. When it comes to the statement of financial position, in capital and liabilities section, we have current liabilities. Then you have rental income in advance. I'm prepaid rental income, 5,000, or the amount that is there. Okay? That is how we deal with prepayments, whether it is a prepaid income or a prepaid expense. Then also, we have accruals. But over here, we have accruals. When we talk about accrual, we have accrued expense. In a big organization, sometimes they incur an expense and then they pay later. In the accrual concept, we say that goods are accounted for when they are, or expenses are accounted for when they are incurred, not when cash is received. So in this case, where we have accrued expense, an example is electricity bill. You consume the electricity, then you pay later. So at the end of the year, in December 2024, bill ya December ilikuja Januari tarehe 5. Okay? Or that is when you paid for the electricity. That is when. So this amount, you have already incurred it. So in the part of expense, if it is electricity expense here, with all the other that has been received, maybe come up with a question in the exam, the trial balance. Kuna expense yenye utapata kwa trial balance. That is what has been paid, okay? But this electricity bill has not been paid, but it is for that year. Hata kama imekuja tarehe 10 Januari, hiyo sio bill ya 2025, ya 2024. So you have to add it here. Okay? So you add what? Accrued. So if this electricity is like 2,000, you add it here. Okay? So that in the income statement, it will be this plus this. So if this there was already some expenses of 1,000. In our income statement, you're going to take 3,000. And then when you come to the income statement, in the part of expenses, our electricity will be 3,000, not 2,000, not 1,000. So it will be that one, okay? Then, there comes the statement of financial position. In this statement of financial position, this accrual, it is what? Is that correct?
Yeah.
So in the place of capital liabilities, this one will be current liability. How much? 2,000. That is accrued expense. Sometimes we have accrued income. We have also the accrued income. Sometimes the income have not been paid, but you have already earned it. It was income for last year. Okay? Somebody has not paid for it. School fees, the same. A student should pay fee during that particular period. Okay? If the year lapses and there is a balance that the student has not been paid, that is not the income for 2025. It is income for 2024. So when you have accrued income, we just treat it like this. So for incomes, maybe you are supposed to receive an income like fees or rent or something. Okay? So, in the accounts, you have received like, let's work with small figures like 2,000. Okay? But there are 2 or 3 clients who have not paid for that particular year. An amount totaling to 3,000. So this is 2024. So even if they will pay in the course of 2025 or even 2026, that is not income for 2025 or 2026. That is the income for 2024. So you add it here. Okay? Accrued, Let's say it's 3,000. So in our income statement, our income statement, sorry, we're going to take how much? 5,000. The amount that's supposed to be. So that is how we treat the accrual concept. And the accrued income is treated like that. So in the income statement, in the part of incomes, you recognize this one. Fees, 5,000. Okay?
Yeah.
In the statement of financial position, in the assets, current assets, there will be what? Accrued income. So, accrued income, how much?
3,000.
3,000. That is how we treat accruals and prepayments. A discount allowed, it represents amount allowed to a customer on his sales. It is given as an incentive. So I can find that you're selling some goods at 2,500. But if a customer buys in bulk, you give him a 5% discount. Okay? Which will be how much? Whichever amount. That is what we mean by a discount. Discount allowed. It is an allowance we give to our customers. Instead of paying 10 shillings, pay 9 per item. And it's normally given as an incentive for bulk purchasing or prompt payment. Discount allowed is in two ways. We have trade discount that is given to customers for bulk purchasing. So when you're selling goods, you encourage people, if you buy at least 5 packets, tuseme unapaka goods zako na packets, okay? If you buy 5 packets and above, you get 2% discount, okay? So this one, and then this one will make the customers to be buying in bulk. Hakuna mwenye atakuwa anapenda kununua less than that, okay? So now you'll be selling more and making more profit. Then pia unapeana cash discount. These customers, they bought the goods on credit, okay? Then unawaambia, if you settle your accounts within 30 days or within 7 days, you also get another 3% discount. Okay? So what will happen to the customers? They'll be trying to pay earlier. Every time anabeba, analipa within the 7 days. After anaenda anachukua goods zingine, na anachukua nyingi, tena analipa tena within 7 days. To enjoy this discount. Remember, this is an expense because your selling price is 2,500. Lakini sasa unamuuzia na less this. Tena unamwambia kilipa na less this. Now, the sale, it is recorded at the invoice value. So when all these things happen, all these transactions happen, what you normally see that is that the sales account, sales will be recorded at the invoice amount. Okay?
Yeah.
So maybe we have sold to David 10,000. Okay? But this David, you have given him a discount. Let's start with 5%. So you have sold him at that amount, isn't it? The double entry is here. But in the invoice, you have told him that you have given him 5% discount. So it means your amount that you're charging him is not 10,000. It is how much? It is 10,000 times 5%, which is 500. He has to pay 9,500. So when he comes to pay, in your cash book, you have put that column for discount allowed. Okay? You will find that in your cash book, you'll have and come and pay what? 9,500. Isn't it?
Yeah.
What about the 500?
Discount allowed.
500. So that it balances with 10,000. Okay? And then now it brings the rest to this one is double entry. So this is David. 500. Okay? Then what happens when you come to the income statements? The sales will be 10,000. Okay? But when it comes to expenses, this one we have other items here. Okay?
Yeah.
When we come to expenses, we will have what?
Discount allowed.
Discount allowed will be an expense here.
500.
500. Among other expenses. That is discount allowed. Discount received on the other hand, when you buy goods from the supplier, some of them they also allow you discounts. That is a discount received. We learned how to post it in cash book. Now we are learning how to transfer it to the financial statements. So, in the case of discount received, it represents cash discount received by a business when it pays suppliers for the amount outstanding. Maybe the supplier will pay a PRO with terms. You pay within 7 days, you get a good discount. Now when you pay, you get a discount. That discount is an income.
Yeah.
So how do you treat it? There is an illustration here. Ole Mabati or the Polango supplied 20,000 and pays time to qualify for 10 cash discount. Show the entries. So the entry, when a person have purchased goods, this is the purchases account. Okay?
Yeah.
Let's work with the simple figure of 10,000. So, this person is James. Okay? He's our supplier. The double entry. And then, when he comes to pay, we give him, or he gives us a 5% discount. So, we are going to pay him how much? 9,500. And then, discount received will be 500. Then, this one will bring another account here, the double entry for this. Discount received. This is from James. 500. Then, when you come to the income statement, in the cost of sales, opening stock, add purchases. Purchases will be stated at the invoice.
Yes.
But after you get the gross profit, which is X, you add discount
Received.
500. Okay. Let's have a treat it. Okay.
Yeah.
This one is not balance calendar. It is going to the income statement. This is debit side, this is credit side. Provision for bad